day, everyone. You're welcome to this week's Business and Investment Tips Program, a production of RCCG Christ Church Radio with Dr. Ayodeji Ebo, an investment professional. This week, our focus is on the Iran war, hidden opportunities and risks for Nigerian businesses, investors, and consumers. The conflict between the United States, Israel, and Iran, prompted by the joint United States-Israeli strikes on 28 February 2026, has quickly developed into a regional war, sometimes referred to as the 2026 Iran War. This involves direct military engagement, retaliatory strikes across the Middle East, and disruption to the vital choke points such as Strait of Hormuz, through which approximately 20 to 30% of global oil passes. Although the duration of the war remains uncertain, there are suggestions it may last 1 to 2 months if confined. Its immediate consequences include rising oil prices. Brent crude oil closed at $92.69 on Friday, up from around $67.57 on the 27th of February, well above the federal government's 2026 oil benchmark of $64.85. For Nigeria, this creates a mixed picture. This week, we explore the probable effects on key economic indicators in Nigeria, along with impacts and strategies for businesses, investors, and consumers. Effects on key economic variables in Nigeria. 1. Oil prices and export revenues. Iran's role as a major oil exporter, around 4 to 5% of global supply, means that a full blockade of Strait of Hormuz could reduce global output by 2 to 5 million barrels per day. For Nigeria, this represents a benefit. Prices above the 2026 budget benchmark of $64.85 per barrel could increase export earnings by $29 per barrel, bolstering foreign reserves and disbursements from the Federation Account Allocation Committee, FAAC, to states. In a prolonged conflict, revenues might rise 20 to 30%, helping with debt payments. However, if global demands fall due to recession fears, prices could plummet after the conflict, damaging long-term stability. 2. Inflation and cost of living. Rising global energy costs will drive domestic inflation, with petrol prices possibly reaching 1,200 per litre, up from the current 700 naira to 800 naira. This leads to increased transportation, food, and manufacturing expenses. Despite local production, Nigeria imports about 60% of its refined fuel based on December 2025 numbers. Core inflation could increase the short term, reducing purchasing power and worsening poverty, affecting over 40% of Nigerians. A brief war might cause only a temporary spike. A prolonged conflict could result in stagflation. Stagflation is a period of high inflation, slow economic growth, and rising unemployment. 3. Currency, Naira stability. Boosted oil revenues could stabilize the Naira by increasing forex inflows, potentially strengthening it against the dollar if reserves increase. However, inflationary pressures and global risk aversion could lead to capital outflows, further devaluing the Naira that saw a 2.0% week-on-week depreciation at the parallel market to 1,395 Naira per dollar. Volatility in the parallel market could widen gaps, affecting remittances and imports. 4. Stock market and financial markets. The Nigerian Stock Exchange (NGX) already saw an initial rally in upstream oil and gas stocks last week, especially in Aradel and Owando, while Seplat stayed flat. The consumer goods and banking sector may dip due to inflation fears. If prolonged, we could see a 5 to 10% market correction, with bonds yielding higher amid risk premiums. Geopolitical uncertainty could deter foreign portfolio investments. 5. Supply chains and trade. Disruptions in Middle East shipping routes, e.g. halted operations by firms like Maersk, will increase freight costs by 20 to 50%, affecting Nigeria's imports of machinery, chemicals, and consumer goods. Exports to Europe and Asia might encounter delays, damaging non-oil sectors such as agriculture. Flight cancellations and airspace restrictions could strand travelers and disrupt business travel. 6. Employment and GDP growth. Short-term GDP might increase by 0.5 to 1% from oil windfalls, but ongoing conflicts could reduce growth by 1 to 2% due to inflation and lower consumer spending. Sectors like manufacturing, already under pressure, could face job losses if impact costs rise. Tourism and aviation might shrink. 1. Impacts and positioning for businesses. Impact. A. Nigerian businesses, especially in import-dependent sectors, e.g. retail and manufacturing, face increasing operational costs due to the rises in fuel and logistic expenses, potentially reducing margins by 10 to 20%. B. For companies in the oil and gas upstream sector, higher oil prices can be beneficial because it improves revenue potential and profitability. Energy-related companies may see stronger earnings if crude prices remain elevated. Supply disruptions might halt production lines, while global uncertainty delays investments. C. Consumer-facing businesses, especially in retail and fast-moving consumer goods, may also feel the impact if households' purchasing power weakens due to higher living costs. In such a setting, companies capable of managing costs effectively and keeping prices competitive will be better positioned. Positioning tips. A. Cost discipline. Businesses should review energy use, logistics, supplier contracts, inventory, and working capital early. Acting before costs spike helps protect margins. B. Supply chain resilience. Firms relying on imports should diversify suppliers, secure critical inventory early, and avoid dependence on a single route or vendor. C. Smart pricing strategy. Instead of blanket price increases, businesses should understand consumer sensitivity. Some products may absorb higher prices, while others may require smaller packs or phased adjustments. D. FX management. Export-oriented and dollar-earning businesses should strengthen treasury management to manage FX volatility and hard currency obligations. 2. Impacts and positioning for investors. Impacts. A. The conflict may cause sector rotation rather than broad market gains. Energy-related companies and export earners may benefit from higher oil prices and improved FX liquidity, while sectors exposed to high import costs, weak consumer demands, and rising energy expenses may face pressure. B. In the equities market, investors should focus on strong fundamentals, companies with solid balance sheets, pricing power, manageable debt, and stable earnings. Energy producers, some banks, and firms with hard currency earnings may remain relatively resilient, while highly leveraged or import-dependent businesses could face challenges. C. For fixed income investors, quality money market and fixed income instruments may remain attractive for stability and liquidity. However, investors should watch real returns, especially if inflation rises due to higher energy and logistics costs. D. The situation also highlights the importance of diversification. Portfolios concentrated in single asset class or currency may become vulnerable during geopolitical shocks. Positioning tips. A. Stay selective and diversified, focusing on fundamentally strong companies with solid cash flow and lower leverage. B. Maintain balanced asset allocation, combining equities with fixed income and some liquidity. C. Approach energy stocks with discipline, avoid emotional chasing despite short-term price spikes. D. Maintain portfolio resilience with a mix of naira assets, dollar exposure, dividend-paying stocks, and defensive sectors. Impacts and positioning for consumers. Impacts. For consumers, the immediate likely impact is a higher cost of living. Transportation expenses could increase, food distribution might become more costly, and businesses may transfer higher energy and logistic costs onto households. Even when inflation is not rising broadly, these shocks often quickly affect daily expenses. The second effect is lower disposable income. Families may find that a larger part of their earnings go to transport, food, fuel, and household essentials. This leaves less money for non-essential spending, traveling, celebrations, and lifestyle purchases. The third impact is heightened uncertainty. During periods of doubt, many consumers delay significant purchases, avoid taking on new debts, and become more price sensitive. This affects demand across various sectors and can slow economic activity beyond just essential categories. Positioning tips. A. Consumers should be more deliberate with budgeting and managing cash flow. During times like these, households need to review transport costs, food planning, energy consumption, and prevent leaks. B. They should also prioritize emergency savings. Geopolitical shocks often cause ripple effects beyond just fuel prices. Prices can fluctuate unexpectedly, and having cash reserves alleviates pressure. C. For families with investable funds, this may also be a good time to separate consumption money from investment money more clearly. Do not allow market headlines or fear of inflation to push short-term household funds into risky assets. In summary, the Iran war is likely to have a dual effect on Nigeria. It can support oil earnings, reserves, and the naira in short term, but it can also raise inflationary pressure through fuel, logistics, freight, and imported input costs. So the headline may look positive for an oil-producing country, but the lived reality can still be difficult for businesses and households if the conflict persists. For businesses, the message is protect margins, secure supply chains, and manage costs early. For investors, the message is stay diversified, focus on quality, and avoid emotional chasing. For consumers, the message is budget carefully, build buffers, and prioritize essentials. In times like this, positioning matters more than panic. Nigeria may benefit from higher oil prices, but only those who respond wisely to the changing environment will truly gain. Thank you for listening. Please join us same time next week for another interesting and insightful session. For questions, comments, and feedback, kindly forward to ebo.ayodeji@gmail.com or send an SMS to 07082463747. Stay blessed and have a great week. Bye.